Good afternoon to our CLA family members, clients, community partners, and friends. Welcome back to our live stream. We sincerely hope that you're continuing to stay safe and healthy at this time. June is the month of gratitude at CLA. As we close on this month, we wanted to take a moment just to say how grateful we are to have all of you with us. Before we dive into our session today, a couple of quick housekeeping items. We will not be doing a session on Thursday, given the upcoming holiday. We know many of you will be taking a long weekend to enjoy much needed time off with family and friends, so we do plan to resume things again next week. Second, we appreciate all of your questions and interaction that have come through our inbox at livestream@claconnect.com. The questions are awesome, and we are constantly monitoring those and responding to them as they keep coming through. They really do help us to tailor important guidance to your needs. So keep them coming throughout the session, and we'll continue to address as many as we can while we're live with you today. And again, as we're in the session, we'll continue to incorporate them into our discussion today. Also, as a reminder, we have a COVID-19 landing page at claconnect.com where you can go for all sorts of up-to-date information about programs, tools, and ways to connect with us for more specific consultation. So today's session is going to be devoted to answering all of your frequently asked questions and fielding questions that have come through from the live stream inbox. Jack and I are going to spend the whole time together to dialogue about these questions. But before we jump into that, it would not be a normal live stream if we did not have some breaking news. So yesterday, we were supposed to have a big deadline today related to carrybacks for 2018 losses for net operating losses related to individuals and C corporations under the quick refund procedures, where those losses were allowed to be faxed to the IRS, again, under an extended quick refund procedure. Now, that was significant for two reasons. One is, again, the faxing was significant because right now the IRS is backlogged, and the ability to fax those in rather than mailing them was going to allow for a much quicker processing timeline of your refund. Secondly, the quick refund procedure, rather than the normal amended return refund procedure, requires that the IRS either process your refund within 90 days or interest starts to run. So the good news is that that deadline was extended yesterday. Again, the deadline was supposed to be today, from June 30th to July 15th. The bad news is they waited till yesterday to extend the deadline, which had some tax practitioners up in arms. But I say all that because it is a great strategy to free up some liquidity. So we do recommend, if you haven't explored 2018 tax strategies or even looked at how do I create a net operating loss for 2019 or 2020, consult your tax advisor and do some thorough tax planning. It is a key part of your whole picture of how you manage your liquidity. So I just wanted to take a moment to bring everyone up to speed on that. And now let's take a moment to pivot back to PPP, and I am welcoming back my good friend, Jack. So
hey,
welcome back.
How you doing today?
Fantastic. All right, so I think you are probably very used now to the format and the fact that we've had the audience submitting questions. And we're going to start today with the questions that have come in earlier, and then we'll move through to some of the live questions that are coming in through the session. So let's start with this question that came in earlier this morning from Beth. Her question is, she has a company that is wondering whether or not they need to meet this lack of business requirement or, any sort of decreased payroll cost to move from the 8-week covered period to the 24-week covered period, or really can it just be a choice that they choose to make in order to ease loan forgiveness documentation requirements? So if they didn't want to have to submit rent and utilities and they thought, hey, I can really easily hit all of my loan requirements with just payroll and that's easier for me. Can I just move to 24 weeks? What are your thoughts on that?
Yeah, there's definitely a lot of confusion around the whole 24-week period and what that means and whether or not you have to do anything to get it. So we'll try to dispel this. So with the PPP Flexibility Act, all loans now have a 24-week covered period. Kind of end of story, right? That 24-week covered period went back to the origination of the CARES Act. However, if your loan originated before the June 5th date, which was before the Flexibility Act, those borrowers have the option, if they want to retain the original 8-week period.
Yep.
So there really is nothing that you need to do as a result of this to get the 24-week period. It's automatic and everybody is available to take advantage of the 24-week period if you want to. So you don't have to meet any kind of significant decrease in business activity or any other kind of qualification to get it. It's just part of the PPP Flexibility Act.
Okay. And so one thing I should, bring up, because I've gotten a couple emails from it, JT Huxford, who practices with us, pinged me right before the session and asked if I could bring it up. So I'm going to, because his clients are asking it. And that is, there's the 8-week period and there's the 24-week period. And I think a lot of clients are confused. Is it just one of the two? Clearly it's yes, we've got the or. And so then they're asking, if it's or, can I still apply for forgiveness once the funds run out?
Yeah, so, the periods are either 8 weeks or 24 weeks. So those are the two periods. However, there was an IFR that came out on June 22nd that gave the borrowers some flexibility. And it actually says that a borrower may submit a loan forgiveness application anytime before the maturity date of their loan, and that it includes submitting an application before the end of the covered period. So even though the covered period would still be 24 weeks, you can submit your loan application before the end of that 24 weeks, right? So that's positive. Now, a couple things though, we have very little guidance on how that is going to work, right? Because there's a lot of tests, whether it's wage reduction or FTE tests, that all relate to the 24-week period. And so we don't know how those are going to apply if, for instance, let's say you decide to use a 13-week period instead, because that's when you've spent all of your loan proceeds that you're going to ask for forgiveness for. So we really don't know how that's going to work yet. The only guidance that we got in that IFR actually related to the wage reduction test. And it basically said that if you had a wage reduction in excess of 25% from your pre-COVID wages, and you were going to use a shorter period, you still have to apply that test as if that person were there for the entire 24 weeks. And so if you reduce somebody's comp by, let's say, $25 more than the 25% reduction, you would take that $25 and multiply it times 24 weeks to determine your wage reduction, even if you were applying after that 13-week period. So you get dinged for the 24-week period, even though you might be applying on a partial period basis. Absent that, we don't have any other guidance. We don't know how it's going to get reflected on the applications yet. So look for more guidance to come out. In true fashion, I'm sure this will get released on either Thursday or Friday, just like the SBA, likes to do to us before a holiday weekend, just like the IRS likes to mess with all you tax preparers.
That's right. So I think, just to reiterate, so people are clear, it is 8 weeks or 24 weeks, and you can start to apply early. We still don't know if you apply early within that 24 weeks, what that means if you do have some reduction in your FTEs, but you would also potentially have the benefit of hindsight then to, if that were detrimental, potentially going back to 8 weeks or looking at planning, right?
Yeah, I would really expect a lot of the folks that are going to apply early are likely going to be able to take advantage of one of the safe harbors that are out there and eliminate the FTE reduction test altogether, and potentially take advantage of the wage safe harbor as well, because they've restored wages or never reduced them, and therefore likely use the EZ form and not have to worry about any of these reductions, right? I suspect that the folks that are going to need to deal with wage reductions and FTE reductions, those calcs are going to be more complicated. They're likely going to use the full 24-week period to get to where they need to be.
Right, that makes sense. Okay, so we have another question that's come in, and it's really, I think, related to starting to get into the mechanics of the forgiveness process. And Deanna wants to know if the SBA has released any specifics on how financial institutions are going to request forgiveness from the SBA.
Yeah, so our good friend Todd Spring obviously is monitoring this, and he's got an entire team that's out there that's ready to help our banks, with this process. But right now, banks are even afraid to accept any applications for forgiveness, because right now there's a 60-day clock, right? So currently, the CARES Act requires banks to process loan forgiveness applications within 60 days. Well, the banks know they can't do that right now. Mm-hmm. While there was an IFR that came out that talked about what the bank needs to do when they receive an application, kind of the verifications and things like that they need to do, there has been no guidance on, once the bank has processed an application, how they can even provide that to the SBA. And so we have heard some presentations by the SBA at this point that have basically said, look, we're going to end up having to give the banks grace on this, because we know we haven't provided them, what are all the rules that you have to live by, and then how are you going to transmit that data to us? And so because of that, we're not going to be able to hold them to that 60-day requirement. Now, we don't know when that guidance is going to come out, but I would suspect that that'll be coming out sooner rather than later, so banks can start accepting applications at least, because right now they're just concerned that they don't want to do that right now. Yeah.
Great. So, it's rare, I think, that we've had much activity in the way of M&A, but I think I've had a few clients that have bought and sold during this time frame, and certainly people are starting to revisit the conversation. So Connie asked a really good question related to the sale of a business, because certainly this forgiveness is going to persist for a little while after all of this is said and done. So she said, what happens if a client applies for a PPP and then uses expenses and enters into a sale agreement before the loan is forgiven?
Yeah, I mean, I got to tell you, we're getting more and more questions now related to this, and in part because people may have weathered the downturn now and are starting to come out the other side. And a lot of people are just saying, geez, I don't want to do this again. Now's a great time. Even though I might get a little less for my business, I don't want to go through the rebuilding process. And so we are seeing a lot of folks now enter the sale market. But in a lot of cases, there were already LOIs in place, right? Mm-hmm. And so there are a host of things that are being, a lot of concerns around the M&A side. And I'll throw a few of these out there right now that we've been considering. And this is not by any means an all-encompassing list. But, the first one is, if there was an LOI out there when you applied for the loan to begin with, there's a couple questions on whether or not you were really even eligible to apply for the loan, right? Because if somebody had agreed to acquire you, mm-hmm. Are they an affiliate now? And do you need to consider them in your employee sizing, right?
So interesting.
So there is some school of thought that says you would have to do that, because you would have to look at that transaction as if it were going to be consummated, particularly if it ultimately went through. Mm-hmm. Now, the other piece is you had to deal with your economic uncertainty, and did you have access to other resources? Well, if somebody's buying you, did you consider the resources from that organization that could have helped pay your employees during that time? And again, if that's the case, did you really have that economic uncertainty that you needed to apply for the loan for forgiveness? So those are a couple of questions on the front end of the loan application process that could come back to bite you if you do a transaction too close to loan forgiveness, right? Now, on the flip side of that, now let's say you didn't have any of that in place at the front end, but now we're dealing with the back end piece and you got a sale transaction. Well, most loans actually have some clauses in there and you need to review your agreement, but the standard agreement with the SBA basically requires the lender and the SBA to bless any change in control. And they define that pretty broadly. So whether it's an asset sale or a sale of equity, we think that you would actually have to go to the SBA and your lender to get approval. Now, I don't know about anybody out there, but right now getting an answer or getting a live person at the SBA to talk to you, let alone give you a waiver or approval of a transaction, is something that's virtually impossible right now. Right. So we're really concerned about that, because if you don't get that consent from them in advance, then in essence, you're in default on that loan and it becomes immediately payable. So a lot of people, when they're going into these transactions, if you talk to your attorney, they will say it might be easier just to pay the loan off and forget about the forgiveness. Now, that's a painful thing to think about, because that could drop directly to, somebody's bottom line as additional purchase consideration. But now that becomes a negotiation point in the whole negotiation, right? The last piece I'll throw out there is, what happens if you've got the loan, you've spent the money, as our questioner brought up, but then forgiveness is going to take 5, 6, 7 months. You may not have even applied for forgiveness yet. How do you deal with that uncertainty, particularly if you're selling the entity, right? So we're seeing people get creative here, right? So now it becomes part of the working capital, maybe using escrows or holdbacks that ultimately get released once forgiveness gets adjudicated. So there's a lot to consider when you're doing M&A transactions. The one thing I'll say is, you need to get an attorney involved, and you need to involve your bank early in the process, because if you think you're going to get this through quickly and something's going to move through the process quickly, given all the uncertainty out there, I think that's a bad assumption. So work with your attorney and bring your bank into the discussions very early on. And that's the surest way to make sure that the transaction will go forward in as smooth a manner as possible.
Well, those points certainly highlight the importance of having good advisors at the table with you when you're doing something like that. So let's just kind of shift our focus for a moment to FTE count questions. So we've got some question from Sarah related to confusion around FTE counts. So she wants to know if you count them by pay period that occurred that month and then take an average for the month, or do you do the payroll over the test period and then average all of them? And, does that same method stand for the covered period? And then I'll ask a couple tag-on questions on that. So maybe let's start with the method for how you count your FTEs and then do a couple tag-along questions.
Sure. Yeah, I think people are waking up in the middle of the night just yelling FTE, FTE, right? It's scaring them because nobody really knows, right? So I think we've got some basic, understanding, right? There's really 3 periods if you're not a seasonal employer that you need to worry about, right? You need to worry about your covered period, and then one of 2 kind of pre-COVID periods, right? Either that January through February 2020 or February 15th through June 30th, 2019, right? So those are kind of your 3 periods you're going to have to calculate FTEs for. Then back to the question, how do you do that? So what we understand is that you look at each pay period within those period of times, right? And you calculate your FTEs in each pay period, and then you just do a simple average. So if you were, let's say you looked at your 8-week covered period, you had 4 biweekly payrolls in there, you would do FTE counts for each one of them, take the total of those, divide it by 4, that would be your average FTE, right? Now you get back to what is an FTE, right? And we've talked a little bit about this in the past, but I'll recap this as well, right? So obviously a salaried individual is 1 FTE. Then you get into your hourly employee bucket, right? And so a full-time hourly employee, which is somebody that works more than 40 hours a week, That is one from an FTE perspective. Whether they work 40 or 50 or 60 hours, it's only one. And then the big calculation and the decision you need to make has to do with your part-time employees, right? So in this case, there's two ways to determine your FTEs related to part-time employees. There's an actual method where you just take the actual hours your part-time employees work and divide it by 40, and that becomes your FTE for your part-time group, right? Or you can use a simplified method, which is just assigning a 0.5 FTE for each part-time employee that you have. And again, adding all those up, that becomes your FTE for the period. I think the important thing to know is that whatever method you use for part-time folks, either that actual hours or your simplified method, you have to apply that consistently. So for all payrolls within your one of those three periods, you apply that consistently, and whatever method you use for your numerator period, your covered period, you have to use that same method for the denominator period as well. So a little primer there. I know there's a lot of questions that exist on FTEs, but hopefully that answered a few of them.
No, I think that's great. And sticking with that, we have another question related to temp workers. So if somebody has temp workers that are employed by a staffing agency, should those be included in the FTE count, or are those considered independent contractors? So the SBA stated that independent contractors can't be included in payroll costs, and they may not know if the staffing agency applied for the PPP.
Yeah, unfortunately, we think that temporary employees, which are generally on the payroll of that temp agency, are unfortunately not part of either your payroll costs or your FTEs, right? Mm-hmm. And we know that some of our employers are having problems as a result of that, because they used to be able to employ people in their business, but now that because of COVID and other things, they haven't been able to hire those people back. So they've had to rely on temp agencies to fill needs for them. However, because those are kind of treated like independent contractors, they're not includable in either your payroll costs that are eligible or in your FTE count. So you kind of get a double whammy there, in that you're not spending money on payroll, even though you are, right? But you don't get to include it in your eligibility. And then you get docked on the FTE count as well. So it's a bad answer, and we hope that we get some guidance there. Right now, the only thing we know where you get a little relief is if you use a PEO, right? So if you do use a professional employer organization, you can include those folks on your payroll if they're specifically designated to your organization. But the temp agency, unfortunately, we don't think you get that good answer.
Okay, that makes sense. We have another one. There's a lot of questions related to safe harbors and also reductions in the workforce that may or may not be related to voluntary reductions or related to sometimes a termination. This one's a question related to a voluntary reduction of hours in the context of a retirement. So they have an employee who was on staff for the entire base period in 19, but during 2020's covered period, they suffered a workers' comp claim and the wages were subsequently substantially reduced. So they're wondering if that disqualifies them from using the EZ form. And then they also have another one nearing retirement that's voluntarily reduced to their hours in 2020. And they're also wondering the impact of that on the EZ. So I think we got to break this down into two pieces. One is workers' comp, which really is a reduction related to almost a short-term disability. And then another one's I'm voluntarily reducing my hours and slowing down.
Yeah, so unfortunately, you may be in trouble on the ability to use the EZ form for either one of those situations, right? So let's take the disability person. So that individual is no longer on your payroll, right? They're getting paid through the disability insurance likely. And as a result of that, you don't have either payroll cost or full-time equivalency. And you can't answer the question, did you maintain your payroll during that period of time? Because in that case, you're down ahead, right? Now, if you hired somebody to replace that individual because you needed somebody to do that body of work, then you still might be able to say, well, we eliminated the reduction, and as a result of that, we still fall under the safe harbor related to that. The second question, though, the voluntarily reduction of hours related to somebody who's nearing retirement, unfortunately, that one doesn't fall under any of the safe harbors that are there related to the EZ form, but it does fall under a safe harbor that's available to you on the loan, the full loan forgiveness application. So that's one of those deals, just like if you fire somebody for cause, or if they voluntarily terminated or had a voluntary reduction of hours. Those are 3 tests that are available if you use the regular loan application, where you don't have to count those people against you from an FTE perspective, but those are not available for use on the EZ form right now. Now, look, we know we're going to get some more updates to both of those forms. Hopefully they incorporate all of those safe harbors that are embedded in the loan forgiveness form into the EZ form as well. That would make it a little bit easier to use that one. But right now, the only way to get the benefits of a voluntary reduction in hours or a voluntary termination is using the long form, unfortunately.
Okay. Now you and I get the joy of tag teaming a tax PPP question. Are you ready for this?
Whoa.
Okay. So we have somebody who has an S corporation, and the S corporation has a single member LLC. So here's the thing, single member LLCs for tax purposes, disregarded entities, Jack. Okay.
I've heard of
so
those.
What that means basically is that they've got 2 individuals here that are paid by the LLC, which effectively means that the owners of the S corporation are effectively getting paid, even though they might be getting paid by the LLC by the S corporation. So they want to know basically if they should be getting owner treatment. And that's where you come in, because I've told you that it's disregarded for tax purposes. So I'm handing this baton to you to answer the question.
Give me the tough part, right? So I guess the answer to that question really lies on where the loan originated, right? If it was at the S corporation, it's pretty clear, right? So if the S corp got the loan, you're clearly limited on those 2 S corp owners to 8 weeks of 2019 comp or 2.5 months of 2019 comp. However, if the loan originated down at the LLC level, now you've got a little bit different animal, right? And so even though for tax purposes, the LLC is a disregarded entity, it's not disregarded from a legal perspective with respect to the loan, right? It is the originating entity. And so normally from an LLC perspective, owners of an LLC get paid via guaranteed payments or K-1 distributions. Sure. They don't get W-2 wages. Now, these owners here, if they're getting W-2 wages, technically they're doing that in an employee setting, not as an owner, right? Although I know that you would look through to that. This is one of those that's very complicated, and there's probably not a right answer to this one. I think you need to use your discretion. My guess is, though, that the loan was likely sized at the LLC level, I would assume, based on a maximum of 100,000 in 8 weeks. So basically 2.5 months of owner comp for 2019 anyway. Yep. And so assuming those 2 employees are the only owners, you're going to get to the same answer, which is the most you'll get forgiven is 2.5 months per employee or owner of the same amount of the prior year amount. And since those 2 employees are likely the only 2 employees of that LLC, given that structure, you'll be able to get to the safe harbor that says you didn't have a reduction in force or anything like that. You would just use the EZ form. So I'm guessing that's the way it would be applied. Those nuanced things, you just need to use your common sense and probably not try to get egregious in the way you're interpreting it and try to get too much benefit to somebody who could potentially be deemed an owner.
Right. I always say pigs get fat, hogs get slaughtered. Let's not get crazy.
I'm with you.
All right. Well, unfortunately, that is all the time that we have for today. So I wanted to thank you, Jack, for the discussion. It's been a ton of fun today. Thank you so much to the viewers for all your questions and for all the people that are manning the live stream inbox behind the scenes for all the support with that. Again, as I mentioned at the beginning, we will be taking a break on Thursday for Independence Day holiday, and we will be back at it again Thursday starting July 9th. We would like to remind you to continue to visit our COVID-19 landing page at claconnect.com for more information on PPP forgiveness, and as well as other hot topics. We've got a lot of information out there right now related to forgiveness tools. We've also got a lot of articles and other information there related to forgiveness. And take a moment to subscribe to our emails. There are links provided in the dialog box below where you can get a ton of other up-to-date information around the forgiveness tool and just other relevant support and information at this time. Please, again, continue to send us your questions. We'll continue to incorporate them in our materials, and we will be back again with you next week. In the meantime, thank you for watching and have a wonderful holiday weekend. Thank you so much.
Happy holidays, everybody.